Ready for a deep dive into something pretty crucial for anyone who even glances at the economy? Today, we're tackling economic forecasting, but get this. We're about to see why factoring in something called financial stress can completely change the game.
It's kind of amazing, really. You see, most economic models, they get so caught up in things like GDP and employment numbers.
Which are all well and good.
Exactly. Lagging indicators. Tell you what's already happened. We're going deeper, exploring how adding a financial stress index right into the mix there can give us a much clearer picture of what's coming down the line, especially when those markets start getting a little, panicky.
And this isn't some abstract market stuff either. We're talking real-world impact. The research we're diving into, it uses two main models as a starting point. The real, or RR, call it the classic approach, I guess, and then the real financial, RF. That's where this whole financial stress element comes in.
Yeah, so the RR model, it's all about those indicators you were talking about, the OECD composite leading indicator. Changes in the consumer price index.
Yeah.
It's almost like a big sturdy ship. Reliable, yeah, but slow to turn.
Not so great when you need to dodge an iceberg.
Exactly. And the research points out some big ones that this model kind of sailed right past. The 1990 Gulf War, for example.
Right, so the RR model.
Yeah, completely missed the signs.
The MSCI USA index tanked almost 6% by September 1990, but the RR model, it just kept chugging along, acting like everything is hunky-dory. And this wasn't just a one-time thing. Similar story with the 2008 Lehman Brothers crisis, that market correction back in late 2018, even the COVID-19 crisis.
So in those moments when we really needed a heads up, the RR model, well, it just wasn't there. And those missed signals, those have consequences. Real consequences, big time. The RF model, on the other hand, the one with the Kansas City Fed Financial Stress Index, the KCFSI, built right in that one, it was a different story. Think of it like a measure of, market panic, if you will. This model, it was able to pick up on these events, these major economic shifts, much more accurately.
It's like it could sense the trouble brewing. So how do these two models actually break down different economic situations? They both use these things called regimes, right?
That's right. So the RR model, it has four regimes. Twin growth, where the economy is growing, but you've got that rising inflation too. Then there's slowing down, where it slows down and inflation cools off. And you've got stagflation, stagnant growth, stubborn inflation, and finally, Goldilocks.
Ah, everyone's favorite.
Right. Positive growth, inflation's under control, everyone's happy.
In a perfect world, maybe. What's really interesting is that the RF model, it goes a totally different route. Heating up, cooling down, hard times, and golden times. And each one of these is showing us a unique way that economic growth and financial stress, how they interact.
Absolutely.
So let's break those down a bit further, shall we? What are we actually looking at with these different...
With the regimes, yeah. So imagine this. The economy is chugging along, growing, but the KCFSI, our financial stress measure, is flashing red. That's heating up. Everything seems fine on the surface, but there's that underlying tension. On the flip side, you've got cooling down. Now, the economy might be slowing down here, but financial stress is easing.
So less panic, even if things aren't exactly booming. Definitely a different way of looking at it than the RR model, that's for sure. But what about those other two? Hard times and golden times? Those sound pretty self-explanatory.
They do, but you know how it is. The details matter. Hard times, it's just like it sounds. Growth is slowing. Financial stress is going through the roof. Markets are freaking out a little. And golden times, well, that's the sweet spot. Growth is good, stress is low, everyone's happy.
So that's pretty ideal. But are these regimes just like theoretical, or do they actually play out when we look at, real world market data?
Now that's the real question, isn't it? And the research actually digs into that. It looks at how the MSCI USA index performed, under each of these regimes. And that's where things get really interesting.
Okay, so numbers time. Did the RR model, the classic one, did it give us any good insights into how the market actually behaves?
It had its moments. For example, under the Goldilocks regime, the MSCI USA index, it did great. Highest expected returns. Investors were loving it. But then you look at some of the other regimes, and it gets a little fuzzy, like twin growth. Even though the economy is growing, right, the returns are actually lower compared to slowing down.
Wait, really? That doesn't seem quite right. Growth, even with some inflation in there, you'd think that'd be good for investors. What's going on there?
Well, you got to remember, investors, They're always looking ahead.
Right.
It's not just about what's happening right now, it's that financial stress element. In a twin growth situation, even with the economy doing well, that rising inflation, it makes people nervous. They start thinking, okay, interest rate hikes might be coming, tighter monetary policies. What's that going to do to corporate profits down the line?
Yeah.
Like, you're enjoying a picnic, but there are some storm clouds on the horizon.
So that underlying anxiety, that's what the RF model is picking up on with that financial stress piece. Okay, but did the RF model actually give a more, I don't know, a more accurate picture when it came to how the market really performed?
Oh, absolutely. Much tighter correlation with how the MSCI USA index actually moved. Like golden times, just like the name suggests, the index was booming during those periods. High returns, low volatility, investors were happy campers.
Yeah.
And on the other side, with hard times, well, the MSCI USA index, it took a hit. Negative returns, high volatility, investors hitting the panic button.
It's amazing. I mean, just adding in that financial stress factor, it's like you get this whole other layer of, well, reality to how the market behaves. It's not just about whether the economy is growing or not. It's about how people feel about it, how they react to it.
Exactly. And that's really where this RF model shines. It brings in that market psychology element. And that, believe me, can be just as powerful as any economic data point out there. But, it's not just about these general trends. The real test is how these models perform when you look at specific times when the economy, when it wasn't doing so hot.
So we're talking about those moments when things go south, right? Economy takes a hit, uncertainty everywhere, markets are like a roller coaster. How did the RR and RF models, how'd they handle that kind of pressure?
Well, that's the real test, isn't it? And the researchers, they dug into this, looked at how well each model actually predicted market moves during those really stressful periods. And let me tell you, the results were, they were eye-opening.
I bet. Spill the tea. What did the data say?
The RF model, with that financial stress component baked right in, it just blew the RR model out of the water when it came to predicting downturns. Like, take the 2008 crisis, for example. The RF model, it was flashing warning signs a full 6 months before the RR model even twitched.
6 months? That's huge.
It is. It was picking up on this increase in financial stress that, honestly, the traditional economic indicators, they were just oblivious to it.
Wow. Imagine if policymakers or even just, regular investors, imagine if they'd had that kind of heads up.
Exactly. And it wasn't just a fluke. Whenever the MSCI USA index had a drop of more than 10%, the RF model, it was right there giving that early warning signal. Way more reliable in those crunch moments.
So it's like we need to bring those traditional economic models into the 21st century, right? They're missing that human element, the whole market psychology piece, and that's what the RF model, with its financial stress measure, that's what it captures.
I think that's a great way to put it. I mean, it's not that the traditional indicators are useless, not at all. But this research, it makes a really strong case for why we need to include financial stress as a vital sign, something we're always keeping an eye on. It's just a more sensitive way to see those market shifts coming.
So for our listeners out there, what's the takeaway? What can they do with this information, this whole financial stress thing? How can they use it to make smarter financial decisions?
I think it's about looking beyond the headlines. Don't just focus on the GDP numbers or the unemployment rate. Pay attention to things that show you how the market is feeling. Things like volatility indexes, credit spreads, even like new sentiment analysis.
Reading between the lines.
Exactly. The market, it doesn't always make sense, but it's always reacting. And those reactions, they can make you or break you. Understanding financial stress, knowing what to look for, it can be a really powerful tool for anyone who wants to, not just survive in the market, but really thrive.
Love it. Knowledge is power, as they say. And today, we are feeling empowered. A huge thank you for taking us on this deep dive. It's been amazing.
It really has. Thanks for having me.
And to all our listeners out there, keep those financial stress indicators on your radar. You never know what hidden signals they might reveal. Until next time, happy investing.